Welcome to this conversation on Business Redefined. Now, the corporate bond market is frothing with activity. We saw Centamri come to the market, Family Bank came to the market, we saw EABL come to the market, Urban Housing late in 2021, and in early 2022, the entity kicking off the activity in this market is the Kenya Mortgage Refinance Companies going to the market, 5-year tenor, looking to raise aggregate about 10.5 billion shillings. We are privileged to have Johnstone Oltetia, the man in charge of the entity. Always a delight to have you.
Thank you, Julian.
Karibu sana. Let's kick this off, Johnston. The timing at which you're going to the market, I'd really like to get your sense in terms of your assessment of it. And why I'm asking that is because for those of us who have followed the yield curve, 2020, 21, now into 22, you can see a gradual uptick. Don't you think pricing could be a bit tricky at this time?
Now, the timing, I think you're very right. The timing of a corporate bond issue is so important, and it actually determines the success of it. Now, we have checked. Remember last year, like you mentioned earlier, we had a number of corporators came to the market, not least EABL, which came in last. We planned to issue our bond at the end of last year. But again, because we had to do a lot of market timing, and of course also don't get into a squeeze with the other corporates that were in the market at that time, we had to move, ours to this year. And this is the right time for us to issue that bond. Now, we have seen the yield curve. We have those numbers from the Nairobi Securities Exchange. It's actually not too bad. And, for purposes of determining the price, a number of factors are considered. Number one, we are pricing it above, a sovereign. And number two, we also have to benchmark against corporates that have come to the market very recently. So we are benchmarking ours mainly on those corporates that came in. So we have the last ones were EABL and Family Bank. Now, the movements or shifts in the yield curve are not, at the moment, are not material. And actually, it provides an opportunity for us to price ours very effectively. So we're still working on the pricing, but we think we have absolutely every reason to say that our pricing will be almost or close to what the other corporates that have come into the market recently, because there is no material shift in the yield curve right at the moment.
Okay. And the aggregate issuance, you're targeting about 10.5 billion shillings. I've seen the first tranche is 1.4 billion. The first tranche is really, really small. And as a market watcher, my question is it an action of testing the waters to see where the market will put the pricing or what?
So it's a couple of factors. So we considered a number of things. Number one, we are new. KMRC is certainly a new corporate in this country. Number two, we have also considered the funding gap that we have. And so based on those two factors, the fact that we need to establish presence in the capital markets for investors to start appreciating KMRC, and the fact that we really don't have a significant funding gap, we had to issue a small ticket initially. And that's exactly what informed the sizing of that first tranche. The subsequent tranches, of course, will be also dependent on a number of factors, not least the fact that we have to get a pipeline of portfolio that we need to refinance, and then also based on the drawdown of the concessional financing that we have. So we still have a lot of concessional resources, and that essentially means that we do not have a significant funding gap at the moment.
When I look at the issuance, I struggle with the aspect of the cost of funds from a KMRC standpoint, and here is why. KMRC on-lends to the primary mortgage lenders at 5%. You're going to the market for commercial credit in the double digits, as we do anticipate, in the tens of percentage points. How do you then ensure that from a cost of funds side, it makes sense for your books?
Well, it makes sense. And I explain, how it makes sense. Now, so I think I mentioned earlier that we have concessional resources that we currently use. But even before I go there, let's just look at KMRC, how it's funded. So this, KMRC is a non-deposit taker. So how is it funded? It's through debt and equity. Equity, of course, is the shareholders' funds, shareholders investing into the company to be owners of the business. And then we have debt, which is essentially the borrowings. It's the loans that we get for that purpose. Now, so when you look at that kind of arrangement, it means we have to, for the longest time, use debt as part of our resources, or part of our funding. Now, so we lend to the primary mortgage lenders, and the greatest thing that we have to consider is the purpose of this institution. The purpose of KMRC is to extend, number one, long-term resources, and number two, they have to be affordable. Because that's the only time you can impact the home loans more effectively. Now, for us to achieve that, we had to look critically at the margins at which KMRC operates. So we have very thin margins, and we continue, and that was done purposely, so that then we can extend, the more concessions to the rest of the market, so that the people can be able to get ultimately. But now going to your question more specifically, so we have huge concessional resources, and then we want to go to the market. So the arrangement is we want to blend those resources. So we blend huge resources of concessional, which are cheaper. So we're talking about 4.5% resources that we have. And this is, from World Bank and the African Development Bank, you're talking about 30 billion. Of course, we are not, but we are not accessing all of it at the same time because it's based on a certain disbursement indicators. Now, for purposes of this bond and the subsequent ones, we had to look at, how much of concessional resources are we going to access during the year, and how much is the funding gap for the upper part of the market. Now, we developed a lending, we call it a blending model, which we actually have also checked with others. For example, we shared with the World Bank to check with us, just to tell us whether or not it's effective, and a number of other financial institutions, including IFC. Now, when we developed the blending model, the intention was, can we blend the resources we have, which are cheaper, with the more expensive resources we're getting or accessing from the capital market? So you're right, we're accessing capital market resources, of course, at market rates, which is, at the moment, at least stands at more than 10%. Now, you use a little of the capital market resources with a lot of the concessional resources, and you blend. When you blend those resources, you have a weighted average cost of money. So
Which is
the weighted average cost of funds is actually lower because it comes down, based on that blending. So we are not going to take any losses. We are not going to suddenly run a business that's going to be making losses. Yeah. So still, we are making money out of it, but it's a thin margin. So that's the reason why we had to create affordability, and therefore we had to take small margins. And the way we run this is that we have built a lot of efficiencies into KMRC, and we are also, running it as a very, thin institution. It's not a large establishment, and that's also purposely because it's more of a development finance institution. So it's a wholesale financial institution, and as a wholesale, you really will not have too many people. So that's the reason. So we maintain low costs and pass the benefits mainly to the people.
So maybe, and I know you might be pressed in terms of the disclosures here, where ideally would you want your weighted average cost of funds to be, considering the sort of blended financing you've talked about?
So where we have the moment, because we have tested our blending model, and we have tested based on what we are going to be issuing right now at the at the market within this month of the corporate bond, and we have determined that our weighted average cost of funds is about 5.1%. So that's where we are. So it's from there now that we price the loans that we're going to be giving to the market, and because it's a very low margin arrangement that we have, we don't expect to lend to the financial institutions at more than 5.3, 5.4, or maximum 5.5%.
I'm wondering, KMRC has access to a vast war chest of concessional financing. Why couldn't you just stick to that? It's cheap credit, and I know every institution wants to kind of diversify its sources of funding, but why go to the market at such expensive rates?
Yeah, a very good question. We have a lot of concessional resources, and but the critical thing we had to look at is sustainability of the institution. Because of what I explained earlier, that this institution does not take deposits. Number one, you have to diversify the sources of funds. But more importantly, you have to determine what are the sources of funds that will lead to sustainability. And from our views, the sustainability of KMRC is predicated on issuing bonds in the capital markets over time and raising financial resources that will then be on lend to the financial institutions. So the reason we decided to go to the market now, as opposed to waiting until we diminish the concessional resources we have, is that we wanted to ensure that we blend the resources and gradually shift the rates over time. But the most significant thing is we want to ensure that the company is sustainable. So we had to create presence in the market, gain a track record over time, and then be able to go to the market whenever you need to raise those resources that we require. And we cannot wait until when we have finished all the resources from the World Bank and the African Development Bank, and then we now try to go to the market. So we had to do some timing to ensure that we have an appropriate time under which we get the investors to start appreciating what kind of institution is KMRC.
Okay. What sort of book building have you done so far? And why I ask that question is because I'm curious to understand to what extent is the fact that you have already been lent by the World Bank a de-risking element for investors who are looking at KMRC?
So we have the World Bank having provided that kind of de-risking arrangement, and actually it's both World Bank and African Development Bank. So the arrangement we have with those institutions is that they will continue to support KMRC over time. And in fact, the support that KMRC has is not only from the World Bank FDB, but we also have IFC, we have Shelter Afrique, we have Government of Kenya, and we have the regulators. All of them have a lot of interest for KMRC to succeed. And so it's very, very important that investors look at KMRC in that light. It's a monoline financial institution with a very single purpose, and therefore even the resources that we're raising from the capital markets, which the CMA is very interested to see where they go, it's so clear for us because it's just one business. We are running only one purpose of a business, and so the resources will suddenly shift to one place. So we don't expect any variations with the kind of funding that we're providing. The only expectation is that we are going to impact more significantly on the market, and then we are going to diversify the number of institutions that operate with KMRC. So we have currently a number of banks, I think 9 in total, and 11 circles, but we want a lot more to come in over time so that then we can diversify the institutions that can reach to the people to be able to provide home loans.
Okay. And still on the aspect of book building, I'm really curious to see what sort of appetite this issuance will attract from the banks. And that's because, one, banks are key stakeholders in your space. Two, you own lend to banks. And whenever we have an issuance in this market, banks and pension funds drive a lot of activity. What do you expect in terms of appetite from banks?
So we have already tested the market. Before we actually got the approvals, we had to do some market sounding and we have done that already. The kind of sentiments we get are very positive. A lot of investors are actually very keen. Initially, they did not understand KMRC because, of course, it's a new institution. But having gone there to provide the story, the sentiments we get is actually very positive. And it's driven mainly by factors like investors have seen, like governance. KMRC has a very strong governance. And number two, it's also driven by the kind of balance sheet that we have. We have about 10 billion balance sheet at the moment. And so investors are already looking at this institution, which in essence, you can describe KMRC as a massive small financial institution, because it's built, it has huge impact that is going to create in the market. So we have talked to banks, and the banks are very keen, especially the banks that are participating with KMRC, the KCB, Corp Bank, NCBA, Stanbic, and a number of others that are currently participating with KMRC, and they have an interest. And the reason why a majority of those institutions will be interested to invest, because this is an investment grade. So these are good investment to have. And this also has been, you've seen the kind of credit rating we got, yes. Which is also based on the same factors. That's good governance and a very strong balance sheet, and the support from a number of strong institutions was also driving that kind of rating that we got. And those institutions are also looking at KMRC on the same light. So we have institutions that come in. Of course, you can imagine that government is also in the market and then tends to crowd in the private sector from the market. But there are a majority of institutions that want to diversify, and number two, they want to go for the yield. Because you're obviously pricing above a sovereign, then some institutions, especially those banks and the pension funds, will be interested in going for the yield.
Okay. On the pricing bit, allow me to ask this question. How easy or difficult has it been coming right on the back of EABL, a company with a very strong track record, which, in my view, received a very high pricing, and now KMRC is coming into the market?
That's an excellent question. So we are still working on the pricing. We have a pricing supplement that is currently under development, which will then give the details of the pricing. So we know the tenors and those other details. And the reason why we don't have a pricing yet is because we needed to do some further market sounding. So we are doing roadshows effective actually today, which is Friday the 14th. While we had already sounded the market earlier and we've actually been testing some pricings, we've not finished. So we want to go back and get the key investors and determine what are their views. But determination of the price, which we are currently working on, is based on a number of things. Number one, we have to benchmark with the corporates that have already come to the market a lot more recently. Like, for example, we have to benchmark with the EABL, Family Bank, which was in the market recently, as well as Centum. Now, that's one key factor that we have to consider. The other key factor, of course, is a yield curve, which is the treasury bonds of the equivalent nature. So we have already seen that. And then, of course, we have the risk premium that we have to look at. So the KMRC is a very low-risk financial institution already. It's extremely low risk. But that notwithstanding, we obviously have to benchmark against those corporates that came into the market. And the most recent one is EABL. So that's what we are looking at the moment. And we'll determine our price actually shortly before the offer opens, which we anticipate will open by 30th of this month. So we are running the roadshows between now and 28th, and then the offer will open. Around that time, will then come with a price, but it will not be too dissimilar with what you saw with the EABL.
Okay. In the June 2021 budget statement, the Treasury CS, Ukuri Yatani, actually did allude to this issuance by KMRC, and he specifically mentioned that you'd be coming into the market with a green bond. So my question is it a green bond? And if that's the case, are you anticipating any concessions from the state in terms of incentives to at least catalyze the uptake and your issuance?
Yeah. So the statement of the CS talked of two things. Yes, it talked about the green bond, but more fundamentally said KMRC is coming in to issue an infrastructure bond. So we tried to get, and actually we received approval from the National Treasury to issue an infrastructure bond. But just before we go into that, so number one, KMRC was obviously looking forward to issuing an infrastructure bond, and then thereafter issue a green bond. So we are still on course to issue a green bond at some stage. But for purposes of issuing a green bond, we have to check on availability of environmental friendly or green properties in the market that we can be able to put the money in. Because you know the difference between a green bond and a conventional bond is just utilization of funds. So we have to be very sure that by the time we are going to the market to issue that green bond, there are those green properties and the financial institutions that are doing the primary mortgage lenders can be able to access, so that then they can originate those loans that KMRC can refinance. We are currently working with IFC and a few other institutions that are working on the green bond issues, and at some stage we'll make a pronouncement as to when we're going to the market to issue a green bond. But going back to the pronouncement of the CS National Treasury, which was great, the issue was for us to initially issue an infrastructure bond. But we ran into a challenge. While the National Treasury had approved, it became impractical for us to obtain the tax exemption from KRA. And the reason is because there was an amendment that was done to the Income Tax Act on the definition of infrastructure bonds. And actually it was a very strange one, because it was just done last year. So when the tax authorities, when of course we engaged the Commissioner General of KRA, he came back to me and said, you know what, the law says this. And that amendment made it impractical for any corporate to issue an infrastructure bond, because it's actually at the moment it's only government which can issue an infrastructure bond. So we are going back to government with a policy proposal for amendment of that definition to enable corporates to issue infrastructure bonds. Otherwise, no corporate can be able to issue infrastructure bonds going forward.
Okay. Still on the prospect of a green bond, have you done any market scoping in terms of the green assets to which the proceeds you raise can be deployed to? Do you have a sense of what the market quantum size would be looking like?
So from what we hear, the green bond market is huge. It's actually that's where the world is going. The world is going green, and therefore we expect that that's a huge market. The National Treasury Climate Finance is currently working on that. We have IFC also, who is participating on the green. We have the Kenya Green Property Development Association, so we have engaged all those parties. We don't have a lot of clarity yet as to what the size is, but generally it's understood that the green bond market, or the green home green market, is obviously a growing one. Now, we expect that will a lot more crystallize when we have the engagement this year, because we're actually planning to have a lot more serious engagement this year with all those parties that are involved, so that we engage the developers and a number of other institutions, and start obviously helping them to see that there is demand for green, especially the financing part that we have, so that then we start engaging parties to be able to start developing those properties. This was also one of the considerations that were made last year during our National Housing Conference that we had on the 8th to 9th of December. A number of factors were considered, but climate-related or friendly development was also one of the key considerations. And we're going to move that going forward to ensure that we go into an environmental friendly housing development very soon.
Okay. As we wrap up this conversation, what's your pipeline looking like, especially now as you go into the market to raise this capital through the bond?
Yeah. So we have currently a pipeline of about 9 billion from the financial institutions, and we're still working on it. And so we expect that we'll have a lot more response. And the reason why we expect a bit more response is because there has been a challenge when you look at supply. So we have a supply of housing that meets the eligibility criteria that we have, which we are talking about 4 million in Nairobi metropolitan area, and 3 million elsewhere. And we could not, or at least the financial institution could not get those properties. Now, so with the diversification of the resources we have, to the extent that now we can lend at a lot higher. So we expect that the financial institutions will now come with, a request from KMRC to finance, 5, 8, 10 million homes, as opposed to the restriction that we have been giving of, up to 4 million. So we expect the pipeline to broaden, especially immediately after we issue the bond, when we have those resources, because there will be far less limitation on, the size of loan that you can issue. But more importantly, we are also working with the State Department of Housing and a number of other, the Kenya Property Development Association, to get to see that there are also developments that are ongoing that KMRC can be able to provide financing for. And that is one of the ways of building our pipeline, to ensure that the resources we get will be, on lent as quickly as possible.
Final question. We're having this conversation on the back of the Affordable Housing Conference of DEC last year. What are some of the key take-homes or resolutions that came from that conference?
We had a number of resolutions, and that was actually one of the greatest conversations we had in a long time. We brought 170 plus people into one room who are all particularly concerned about housing. Now, the kind of resolutions we had were mainly to address the environmental challenges that we face in the housing market. And the conversation shifted into who are the key drivers. So number one, we have the State Department of Housing with some key resolutions focused on that. We have the Ministry of Lands and Planning, which is key resolutions around there. We have National Treasury, we have KMRC, and then we have the private developers. Now, some of the key resolutions were mainly on the Ministry of Lands. The digitization processes, the registration processes which take long, and the resolutions were for creating efficiency within the Ministry of Lands to be able to enable easy registration and easy access of titling and things like that. From the State Department of Housing, it's mainly about supply, and so the resolution was, how do we rebuild the Boma Yangu for it to provide effective demand? Because people have expressed interest. We have about 300,000 people under Boma Yangu who want houses, but is that effective demand? No. So the idea is to put in some form of consultancy to create some effective demand, and then do some credit referencing that will be done on those, and then obviously become useful information for consideration by the financial institutions. The key one around the National Treasury is an amendment to the definition of infrastructure bond, which is inhibiting corporates from going to the market. And so that was one of the key resolutions that also came in, that, we need this amendment to be done so that, we encourage further developments in the capital markets and corporates to go to the market. Now, developments within the property, and I think the other one was about tax concessions that we have. The government provided some tax benefits for housing development. That could not crystallize because there are no regulations enabling that for KRA to be able to effect. And so that was one of the other resolutions, that we need a mechanism or a structure that enables private sector developers and any other developer to be able to get the tax concessions that have been provided by government.
And that takes us to the close of our conversation with Mr. Johnstone Oltetia, the Chief Executive Officer at Kenya Mortgage Refinance Company, where we have been focusing on the bond which should be raising a targeted 10.5 billion shillings. Remember, any corporate action happens, you have all the details here on Business Redefined, so stay tuned.